Shard, thanks so much for doing this. So, basically, this is going to be the third learning pack that TBO has done. Like we're posting on LinkedIn. It's going to be talking about venture capital, how companies think about, how venture capital funds think about investing in startups, and we're going to be using the example of Airbnb here, and we'll touch on Ashton Kutcher and celebrities and how they kind of like what kind of returns they make by investing early on in such huge companies. But to kick us off, okay, so we'll start. Our VC fund is very imaginatively named ABC Capital, and we're managing £100 million, let's say £100 million, $100 million. Now, do you want to just quickly walk us through these lines just to kind of set us up, and then I'll take it from Airbnb.
Yeah, sure. So I think that the whole purpose of this first bit is basically to get everyone in the mindset of how a VC thinks about any one investment they make. What is kind of the minimum return that they need to make on that investment? And so a venture fund, if people aren't familiar, as a venture capitalist, you get given a pot of money. Here it's 100 million. Our job is to invest that into a bunch of technology startups, support them through to an exit, an acquisition, or a listing.
Yep.
And then hopefully we make some money for our investors and we give that money back. And so typically this is how it works. So if we start at the top, 100 million fund, about typical, I would say, sometimes more, sometimes less. The second bit, usually it's if 50% is invested in a company on day one of the investment, and then you hold back 50% of the fund to invest in further stages of the company, like later rounds of funding, basically.
Okay, so like when you're, I guess when like a company first pitches itself, and if you want to go ahead with it, you would say, okay, the pot of money that we have, we'll invest 50% now, and 50% for what? For if they raise again in future, or if they're struggling with cash and you need to inject some more.
Yeah, and so here the whole thing is like you're balancing out your risk. Like a lot of these tech companies, there's only a handful that just go to the moon, as the phrase goes. In reality, the journey is always a lot more rocky. Like there's a company called UiPath that took 10 years to scale. And so in that instance, you want to be able to have some money to continue to fund the company if they're going through a rocky period. Likewise, if they raise a big round, you can invest again to defend your position.
Perfect. Okay, so we're saying about 50% goes into initial tickets. So out of that 100 million, around 50 million is saved for like the initial investments. How many startups are you thinking of investing with that 100 million?
Yeah, so again, this depends on like your speciality as a fund. I would say on average, a typical early stage portfolio is about 30 companies.
30 companies. Okay, interesting. And then this is kind of what you're saying. I find this so interesting is, I mean, especially for someone who like worked in asset management and stuff, right? Like you said, there's very few that go to the moon, but the failure rate is huge, right? Like what are we saying? What 70%, 80%, like higher?
So I think the often quoted figure for startups in general is about 90% will fail.
You're saying so I'll put that in there. So you're saying that out of those 30 startups, 90% will what? What you invested, you'll lose.
It could be that, but I think also a failure for a VC is kind of what they call a zombie company.
Yeah,
it's essentially a company that like maybe they get to about $1 million in annual revenue, but then they're cash flow positive. They never really have to raise, but they never really have to scale quickly.
Okay.
And then they get better competitors, and they just kind of move sideways until the founder gets bored.
Okay,
so,
fine.
Yeah.
So if we say, 30 companies that you'd typically invest in, 90% failure rate, so the startups remaining are obviously 30.
And
3 startups remaining.
Yeah, and I would say the way to think about it here is like these 3 startups are going out of those 30, they're the ones that are really going to drive the return of the fund. You may make some money on startups 4 till 10. You might get like a 2 times your money or 3 times your money. But you'll see later we're investing like 1-2 million. That doesn't move the needle for the fund. So these 3 are where you put all your effort into basically for the fund.
Fine. We have target fund return here. So this is kind of what you're saying is with the 100 million fund, what you're trying to turn this into over X amount of years.
Yeah, yeah, and so a venture fund lasts for 10 years. So you
Yep.
typically invest your money between years 1 and 3 or years 1 and 4.
Okay.
And then for the following 6 years, you're supporting the companies, and you're typically exiting the positions between years 7 to 10, something like
Okay.
that. Every venture fund, the benchmark is 3 times your money. So if you invest 100, you want to get 300 back. I think I can't remember the stat off the top of my head. Maybe we can share it afterwards. But the majority of venture funds don't even return 1 times the money. So over
Well,
10
after
years,
10 years.
a majority of funds, return less than 100 million to their LPs. So they lose the money over
Oh
10
wow.
years.
Wait, so just to clarify, this is you that 100 million becomes 300 million. It's not 300 million profit, it's 200 million profit.
200 million profit, yeah. And I think
Yeah,
when
okay.
you do the math, it nets out to about 20% IRR is the benchmark people are aiming for.
Okay, fine. Fine. So then what we're kind of getting to here is the investment return requirement is that if so you've invested in 30 companies, 100 million, and you're hoping to get 300 million out of it, and a lot of that is coming from 3 startups.
Yeah.
So these 3 startups probably need to be making about 100 million each.
So not making, as in returning you 100 million. So your
Yeah,
stake in those companies
yeah,
should be worth about 100 million each when you sell them in an ideal
yes,
sense.
yeah.
Yeah.
So kind of
So your investment
how?
requirement. So they should return the fund at least 1 time.
Okay, so we're saying what
Actually, it's
300
funnily
million.
enough, in a lot of venture funds, it gets skewed even more towards like one asset. So, for example, in our fund at the moment, there's
Mm,
one clear winner that if it does well, it will be like a 5 times fund,
wow.
for example, and the rest will do like minimal
Okay.
amounts.
Yeah. Okay, interesting. Okay, so we're saying 300 million is kind of what you're trying to return divided by the initial fund divided by how many startups there are. So you're saying, yeah, each startup, each of these winners, like let's say, yeah, each of these winners, you're trying to return the valuation. Well, yeah, the return for you from that investment needs to be 100 million, basically.
For this fund, I would say
For
generally
this fund,
yes.
yeah.
This metric of 1 times your fund should be like the minimum standard. Like every investment should be able to return the fund at least, and
Okay,
hopefully more.
okay, perfect. Okay, that sets things up nicely. Okay, so if we just look at Airbnb now, okay, so back in 2010, they went for their Series A funding. They went with a valuation of 70 million, and they were going for like a 7 million raise. Now, if we say, like we said, 50 million for initial tickets, 30 startups, that goes to about like 1.67 million per initial investment. If we say 1.4, I think to make it a bit more round, because 1.4 million out of 70 million is a 2% ownership. So we say we
Mhm.
invest 1.4 million. This fund, ABC Capital, invests 1.4 million to Airbnb in Series A. We take 2% ownership and investment. But then the key thing is, what is the ownership at exit, right? So
Yeah, exactly.
I just noticed we had a little spelling mistake here as well. Ownership at exit. So, and then when you're thinking about exit, because you mentioned between years 7 and 10 is when you're looking to exit, and that's either through acquisition or IPO, obviously. And I think you'd mentioned this before to me, Stroud, of like there's no huge science here. It's kind of just saying, okay, let's see, the company will probably raise. I mean, ideally, the company will raise 1 or 2 more times, and then it'll be cash flow generative and stuff. But usually, the company might raise 4 or 5 times, and then it will IPO.
The dream for a venture investor, yes, is that they get to a listing, because typically that's where you maximize kind of the exit value.
Yeah.
I think, you know, often once a company gets to Series E, Series F kind of valuations, they're so large that there aren't that many corporates in the market that can buy them, that has the cash
Mm,
to buy them. And so
mm.
listing really kind of is the only opportunity there. And
Okay.
M&A deals are usually at kind of a discount to listing anyway, right? Like the buyer wants some sort of premium.
Yeah. Okay, so if we say here, company after Series A, if we invest in them at Series A, they raise B, C, D, E, F rounds, and then the IPO, which would be 6 rounds. before, yeah, at 6 rounds, including the IPO. If we say a dilution per round, so what we're meaning here is when the company raises every time, like here they're giving away 10% of their shares because they're raising 7 million at valuation of 70. If we're saying they give 10% away every single round, that would be our dilution. Which means at exit, just to be clear actually about that, I don't want to rush past that, is if we have 2% ownership at investment, if the company raises 10% in Series B, our ownership goes from 2% to 1.8%, right?
8%. Yeah.
Yeah. And then when it raises 10% at C, we go from 1.8% to 1.62% because we again lose 10%. So
yeah,
kind of like
and just to maybe cover one point here. When we talked earlier about this, amount reserved for follow-on, so you get 50 million for initial and 50 for follow-on.
Yeah.
Some of that 50 can go into here, the Series B.
Yeah.
And that means you wouldn't actually, it's called taking your pro rata in a round. So if we own it's hypothetical, if we own 2% of Airbnb, they go on to raise 100 million in their Series B, then we have the right to invest 2% of 100 million. That's like our allocation in the round. If we have 2 million to invest,
so our ownership stays at 2%.
If we invest 2% of the round,
yeah. Okay. I mean, to keep things simple, we'll say, listen, we've invested the initial round, and we're not going to invest again.
Yeah. I think it's good for the example.
Yeah. Okay, so what does that mean? So it means that we invested 1.4 million at Series A. We own 2% of Airbnb. That gets diluted down at IPO to 1.1% stake. Now, remember, so what's the required return at exit? This means we invested 1.4 and we said we need 1 times the fund, which is 100 million. So we want 101.4 million. Our stake in Airbnb needs to be worth 101.4 million when the company IPOs. So for that to be the case, this 101.4 million, that needs to be 1.1% of Airbnb, right?
Yeah, exactly.
So if Airbnb needs to hit 9.54 billion, and then 1.1% of that would be 101.4 million, which would make us our return that we're looking for.
Yeah.
Right? Okay. But I mean, how would you think about that from like a fundamental perspective, Stroud? Because 9.54 billion, like we can say, yeah, the company needs to hit this valuation, but what does that mean in terms of actual like revenues or profits? Like, how would you think about this is like the target we need to get to in terms of revenue, for instance?
I think, in terms of revenue, there's a couple of ways of looking at it. Normally, you can get a quick read through reading a couple of reports of just how big, in this instance, I don't know what it would be, the homestay market, the vacation rental market, the hotel market.
Yeah.
If individually they were all north of 100 billion or even more, then you kind of eyeball it and say like, okay, 10 billion is 10% of the global market. Is that actually realistic? But I think to your point, a more tangible metric is to tie it back to revenue. And so I think, here you'll probably work back with a revenue multiple to get to a sense of, okay, to reach this valuation, how much revenue does Airbnb need to make at exit?
Yeah.
And then you start layering on the lens of, okay, is that feasible to do or not?
Okay. I mean, I think 10 times revenue seems about right for valuations. Okay, we'll go with 10 times, which means the company needs to be hitting revenues of 954 million at exit. So
and crucially, like the other thing that you mentioned is it not only has to hit 954 million in revenue, it has to hit 954 million in revenue in the 10-year window.
Yes.
And then sometimes even less. So if I invested it in year 4, I have 6 years to get it to this kind of level.
Yeah. So I guess the takeaway here for this first slide, just to like set things all up, is can Airbnb hit 954 million, basically $1 billion of revenue by the time of IPO, right?
Yeah.
Okay, let me just get that down. Yeah, a revenue.
And I think this is a helpful. It's a very simplistic example, but I think it's very helpful just to understand the general kind of logic of how a VC should think and how you back calculate, the necessary revenue evaluation.
Yeah,
because in reality, stuff like dilution per round may be as high as 25%, or
it could
so
be
your ownership could be wildly different. Yeah, so usually a Series Series B might be at 20%, Series A will be 25, D
Right.
onwards would be 10. But like,
It's interesting.
there's
That's kind of okay. I mean, I won't ruin it actually. I'll wait for the next slide. I'll wait for the next tab because that's kind of what you're going to be talking about. Similar kind of thing. So
yeah.
that's the takeaway. As we quickly just divert and we'll get back to Airbnb. Do you want to just quickly explain? Because I think this will be useful for watchers, listeners. Like we said here that ABC Capital works with a fund size of 100 million. Can you maybe just talk us through what happens if the fund size actually is 500 million?
Yeah, I'll do it very quickly. I think it's just
Yeah.
it's a minor point, but I think it's quite an important one, especially if you know we have founders or future founders listening that may need to think about this.
Mm.
Sometimes it can be tempting to raise from like the biggest, best funds in Europe that have, you know, hundreds of millions under management. That can be great as well, because if they've got money to back you later down the line and you need to raise hundreds of millions, then great.
Yeah.
But I think what you kind of sacrifice for that is the pressure that they will put on you to grow as quickly as possible. They once they're in, they need a massive outcome for them to be incentivized. And I think it's displayed here, right? So like on the previous slide with a 100 million fund, we needed we needed a $10 billion outcome. Something like that.
We needed 9.54 billion.
9.5 billion, a billion in revenue. Here, just with 5 times the fund size, 500 million, suddenly to return that fund, this venture capitalist needs a $47 billion outcome.
Yeah.
Which is
because just to be clear, the only thing we've changed is that, right? That's the only thing we've changed. We've said it still needs to return 1 times the fund. So any investment needs to make 500 million now. So the required return is 500 million. But for 1.1% to equal 500 million, Airbnb needs to hit 47 billion in valuation, which is
And maybe one thing here is that actually sometimes a 500 million and a 100 million fund will be competing at the early stages, like a Series A. But in times gone by, usually if you've got a massive fund like this, you'll be investing bigger tickets later on in the journey. It's like a Series C and D.
Right.
So maybe one thing just to tweak it, you could, let's say this fund took all 7 million. So if you change 1.4 to 7, and then it actually does come down slightly. But like if they were competing at everything else being equal and only fund size changing, the dynamic is crazily different and the incentives are very different. And you know, there might be things like if you wanted to sell at close to 10 billion or just over 10 billion, fund 1 might help facilitate that sale, whereas this fund might block that sale, even though 10 billion is life-changing for you. Actually no, like I would need 50, so you're going to keep building the company for me, and suddenly you lose control of how you want to build a company.
So what's what's the like key takeaway you'd say from this?
I think the key takeaway for me, if I was advising a founder, would just to really understand and ask a VC, what does success look like for you with this investment? And then to ask questions like, how big is your fund? How many investments are you going to make? And then try to back calculate what that valuation needs to be to return 1 times of their fund in that situation. And if it's wholly unreasonable and you think the incentives will be a bit weird, then don't take that money and take someone else's money.
Perfect. So ask a VC, what does success look like for them with this investment? 500 million fund does not equal $100 million fund. Cool. Let's move on. Sounds good. Cheers for that, Stroud. I'll leave the data there for now. Okay, so let's get back to Airbnb. Okay, so we've kind of looked at, okay, so for this investment to work, we've invested ABC Capital, we've invested $1.4 million. For us to get the required return we want, Airbnb has to hit 954 million in revenue by the time of IPO. So now let's actually like work backwards and see how many users do we need, how many houses do we need, all of these kind of things. Okay, and like for anyone who's, I think you read it late, Stroud, but like for TBO listeners, we obviously did the business of Airbnb a few weeks back, and so we went through the different revenue drivers. So we're kind of just going to use those kind of like lines now. So I'll put some assumptions down. Try and tell me if any of them are widely wrong or you want to tweak any of them or something like that. Okay. So I guess average nights per trip, let's go with 4. Average nightly rate, keep it simple, we'll go with 100. So we're saying every trip on Airbnb is going to be on average 4 nights. The hosts will charge guests around $100 per night. So total booking value will be 400 for a trip. Airbnb will charge, and you can talk about the supply side in a second, but Airbnb are going to charge guests 10% for in terms of service fee, which means Airbnb's revenue per trip is 40. Do you want to just talk about the supply side there just quickly?
In terms of
take rate.
What exactly? In terms of take rate? In terms of like who they charged to start with. Yeah, okay. So Airbnb is a marketplace fundamentally. It's connecting, suppliers of vacation space to buyers of renters of vacation space.
Yeah.
In marketplace models, when you're starting as a startup, the most important thing is supply.
Yeah.
This is a consumer-facing app. If I log onto Airbnb when I'm in Lisbon, I'm going to holiday to Lisbon, and there's no homes there. I'm never going to use Airbnb again.
Yeah.
And so you really, really need good supply when you're launching.
Like you said, it's in other consumer apps as well. I think you used the example of a dating app like the other week. Like if you go on and you don't see any users on there, or you swipe 5 times, there's no users, you're not going to use that again.
Yeah, and I think you just got to think like a consumer's tastes are so fickle now. Like if the experience is crap, they'll go somewhere else.
Yeah.
Excuse the language. I don't know whether crap's a swear word on TV. But supply side in this case, before this, you'd never be able to rent your home out as easily as this.
Yeah.
And so you probably give Airbnb a bit more leeway if they didn't find your customer for a few months and you were on a wait list or whatever.
Yeah.
So I think the point you wanted was at the start, Airbnb are taking a 10% cut of this gross booking value, 400. But they actually didn't charge the supply side because they wanted to get as many people on the platform as possible.
Yeah.
So all of this
10% from guests, but not from hosts.
But not from hosts, exactly. Yeah.
Yeah. Okay. Perfect. So we're saying revenue per trip is $40 Airbnb makes. Now we said at IPO the revenue target, remember we said was 954 million. So how many trips do we need to satisfy that revenue target is 24 million trips. Now, a key point here is it's not 24 million users because you don't need, for 24 million trips, you don't need 24 million users because one user might use Airbnb several times. So, one user might use it 4 times, 5 times, 2 times. On average, if we say the average user uses Airbnb 1.5 times, it means that we'd actually need about 16 million users on Airbnb. That will get us to our revenue target, and I think that makes fair amount of sense. We're going to sense check this number in a couple of tabs time, but we'll go with that. Happy to move on.
Yeah, 6 billion people in the world.
6 billion people in the world. Yeah. We got 16 million. Okay. All right. So let's move on. Okay, and this is an important. You mentioned supply side. Okay, and it's important because, as you said. Okay, let's say we've got 16 million users, but there's 5 homes. All right, they're not going to be satisfied. So this is how many listings, how many homes do there need to be to satisfy 16 million users? So we'll just fill this in. So annual trips needed to hit the IPO revenue target. Annual trips you said was 24 million. And this is the key one. So how many annual bookings per listing? So do we need for 24 million trips? Do we need 24 million bookings? Probably not, because that would mean that every listing. Sorry, for 24 million trips, do we need 24 million listings? Probably not, because that would mean every listing only gets booked once in
a year. Yeah, exactly. Yeah.
And I mean, what do you think? I think 10 is probably quite high because that would be nearly every month, maybe once every 2 months. I mean, you're an Airbnb host, aren't you? You can tell me.
Yeah, the demand is honestly crazy. So I think I think average out once every 2 months makes sense because you'll get people that do this professionally that will be renting out all year and they'll be getting 2-3 a month. And you'll get people that do it casually when they go on holiday and need to rent the home for some money.
Yeah,
they might do it like once, twice a year. And so on
Okay.
average, it probably 2 a month. Oh, 6 a year is probably fair.
Okay. Perfect. Um, so we've got 6 bookings per listing, and we've got 24 million bookings. That means we need just under 4 million listings. That's not exactly 24 because that's calculation. So we need 4 million listings on Airbnb to satisfy our investment in this. Okay. And Mate, how about I'll take the households one and you can take the hotel nights on the next
Yeah.
tab.
Yeah.
So
Yeah. Sounds good.
I mean, there's plenty of ways to forecast this. Like, I mean, how do you come to that conclusion of are we going to get 4 million listings onto this platform? A very simple way that we've kind of done this is how many households are there across the world, and what percentage of those households have a second home? Because at the moment, tell me if you jump in by the way if you disagree with anything or you think this is something that we might have missed, but we obviously can't change it now. But like for like actual VC funds, what they might be looking at as well, because I think what Airbnb is used now is people with their first homes when they go out on a weekend or on holiday, they'll rent their first homes out. But I think
Yeah.
10 years ago, I think maybe it's a safer assumption to say, okay, the initial first hosts would have people with second homes who are renting it out or have, yeah. I think
No,
that's
I agree. I agree. I think it's like almost like professional landlords that have a second home.
yeah,
Whereas before they'd have to like call mates to see if someone wants to stay in them, or
yeah,
they might do them for a real estate agent. So
yeah,
it's
exactly.
really, really kind of manual stuff. Whereas this gives
Yeah,
them an easy way to access,
yeah.
demand.
So
I think it's fair.
I found data for number of households in these countries. So in the US, there's about 110 million households. Europe, 180 million. South America, about 150 million. Rest of the world, I left blank because I don't think we're going to have all the households in China as like an addressable market or places in Asia or different parts of Africa and things. So I'm not sure what we want to do here. Should we keep this blank or should we keep this 100 million? I'm happy with anywhere in between.
I don't know if Airbnb is going to be global. Give it something.
Yeah,
Yeah.
give it something. Maybe let's give it. I mean, rest of the world is huge. Let's give it 100 million. Okay.
Yeah.
So if we sum that up, the number of households in total are 500 million, 540 million households, addressable households. There's obviously more households, but we're saying like addressable households that could that could list properties. So percentage of addressable households with second home. So this is where a bit of research is required. I mean, a lot of research for a VC fund, but like for people who are thinking about this, this number doesn't just fly out of the sky. There's loads of like research surveys and things that to be done. From like a quick Google search, you can find that the number of households or number of people who have a second home in places like America and the US is around 10%. And so I'll kind of use that figure for this calculation, which means the number of second homes there are for us is 54 million, right? And so just to kind of finish this off is how many of those second homes would need to be listed? So remember, we need 4 million listings on this platform to make our valuation work. There's 54 million addressable homes, second homes out there, which means we're saying 7.4% of these addressable second homes need to be listed. And first of all, what are your thoughts there? Because that's not a crazy number. Like the way I think about that is like, it's kind of like a sense check to be like, okay, that's not outlandish. I mean, if this was something like 4, we're saying 99% of the addressable second homes need to be listed. Whereas it's not the case, we're saying it's only 7%. Like, I mean, this is very simplistic. So maybe jump in and say where.
Yeah, I think as a thought exercise, it makes sense. Like you're never really going to know, and I think these are the kind of ballpark estimations that you need to do. Just to, like you said, just to check that it's closer to zero than it is to 100%. Like
Yeah, yeah,
like
yeah,
you
yeah.
just shown, and that's roughly achievable. And then there's unknowns, like you said. Okay, we assume then it's only second homes, but the reality is that people are renting out their first homes.
Mm.
Maybe people, one household, I don't know how households are calculated here. Maybe one household owns multiple buy to lets, and this household's numbers underestimated. But I think it's useful as a ballpark estimate. I
Yeah.
think in reality, like if you're going through like serious DD for this in like a live case, you would probably drill down into all of those continents to get a more granular view of like, the biggest example that springs to mind here is back in 2008 when Airbnb started, right? Latin America didn't even have like digital payments infrastructure,
Mm.
there would have been so much like fraud risk here that no
Yeah,
one
yeah,
would
yeah,
rent
yeah.
their home. And so actually that number would probably be closer to zero.
In
And
South America.
yeah, right. But then if those go to zero, your number goes higher here, but then maybe first homes come into account. What I'm saying is,
Yeah,
yeah, there's different ways to analyze it. I think it's a useful
yeah,
ballpark number, and you can go at it from a number of different angles, which I think we'll probably do in a second.
yeah. Perfect. Okay, so that's kind of the supply side of things. I'll let you. I'll kind of like just do this bit here for demand, and then you can go into hotel nights and how you'd kind of think about mapping out demand there. So if we just go back to our IPO revenue target, as we said again, is 954 million. How many annual trips are required for that? Is 24 million. We said the average trips per user was 1.5 times, which would mean 16 million users. So how do you kind of, like we did with supply, thinking we need 4 million listings, how do you think, okay, how do we get 16 million users?
Yeah, so I think I think one other way to attack it. I think one thing you said was on second home listings and checking out the supply. On the demand side, the most obvious comparison, especially looking at it in hindsight, is where do we stay when we go on holiday? And at least until I may even be misremembering, at least until I was like 21. It's not that many years ago. You wouldn't think of staying anywhere other than a hotel. Like
Yeah.
not talking like always in like a nice hotel, but any hotel,
Yeah,
that would be always front of mind. That's where you'd start to look.
for sure.
If you could, so I think an interesting way of analyzing it on the demand side is, okay, you need to convince a certain percentage of people that default go to a hotel,
Yeah,
that Airbnb is a better proposition.
yeah,
And now it seems so obvious, but like back then it's like, okay, you're staying in someone's house. Like that is very weird, and it's potentially unsafe.
Do you, but I
Um,
mean, because we're going to get onto that next tab, because that's kind of how Airbnb saw it as well. They kind of looked at it as trips well run. Is there any other way to do it apart from hotel nights booked? Like, I can't think of much, but like, because
so I think that they massively underestimated their market to start with, right? Like,
yeah, we'll talk about it.
I think yeah, I think maybe that's in the reality tab, so I won't
Yeah,
spoil it. But like,
yeah,
I think they really went after the only other way to do it is to narrow your market, the market definition that you're going after, and to target a certain type of consumer. So maybe you pitch Airbnb to backpackers,
yeah,
like
yeah.
they can't afford hotels, and so how many backpackers travel, and you can kind of get to a number there. It'll be much smaller, but yeah, other than hotel nights, if you wanted to get more granular, I would really hone in on a buyer type and
Okay,
try and
okay,
work that way.
okay, perfect. So I guess hotel nights booked again. I found some data for you, and you can maybe talk us through this. So I actually found hotel nights booked like it's like 1.3 billion now. So I kind of worked back like 15 years, like at 3% growth rate kind of thing, but it's about 160 million. Europe about 1.4 billion. South America, I didn't find loads of great data on this, but it's about 500 million. Rest of the world, I'm not sure what we want to do here again. I think we'll
I think Asia was probably a just as mature a market as South America.
okay.
So I don't know what. If you do zero, you do 500, whatever.
Let's put the same in. Yeah, let's put the same in, and we'll sum that up. So we're saying about 3.4 billion hotel nights booked across the world, which I think is slightly high, but I don't think it's actually too bad. We can maybe tweak the rest of the world in a second. But this is the second thing, by the way, because hotel nights booked, Stroud, like, sure, there's holiday goers, but you're not going to get business people. Like, initially, like, the pitch is people going on holidays, staying in hotels could convert to Airbnb, right? Not business travelers.
Yes, it's a fair point,
Yeah.
and for two reasons, which I'll quickly cover.
Yeah.
In my mind, the value prop of Airbnb was twofold.
Mm.
One, at least initially, it was cheaper.
Mm.
Two, it was a better experience because it was more like local. You had like a local
Yeah.
home,
Yeah.
a local host, blah blah blah.
Yeah.
I don't think for a business traveler, either of those really resonates because
Yeah.
one, you're expensing your hotel, so you
Yeah.
just pay for like nice, yeah, luxury,
Yeah.
and
Yeah.
two, you don't really want to, if you're in a suit, you don't really want to bother with a.
Yeah.
You're not going there for experience, right? It's business is business. So
Yeah. 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 Okay.
yeah, I think
So basically, again, a bit of research found that percentage of hotel nights that are through business is around 20%. So about 80% of hotel nights are leisure. So if
yeah,
we look at it like that, that means that hotel nights leisure is around 2.7 billion. And if we then work back to like how many trips that is, kind of, so how many nights per trip? We said 4 for Airbnb. I don't know why, but I have this gut feeling that like trips per hotel booking might be slightly longer. I don't know why.
yeah, yeah, fine with that. What are you gonna go with 5?
Yeah, I don't know. I think 5 or 6 might make sense. I
I think that's fair.
I guess. Um, Number of leisure trips. Yeah, so that means that 2.7 billion nights works out to about 544 million trips. Again, if we say the average person like it's not using it once, maybe using 1.5 times going on these holiday trips using hotels, means that number of people booking leisure hotel trips is 363 million. Now, you said that the kind of aim here is how many of those people can we convert to Airbnb, right?
Mm.
And so we needed 16 million out of 363 is about 4.4%, which again is fairly good, right? Even if we
Yeah, if you
put
took out rest of the world,
took out even
yeah,
if we took out South America, like it's strong. Like the demand is there from the US and Europe, you'd say.
yeah, even if you took down number of nights per trip, right? Like, what is that gonna?
Uh, I didn't, or if I went the other way,
Yeah, they went the other way. Sorry, yeah.
yeah.
Um, yeah, exactly. It's a wholly reasonable.
Yeah, wholly reasonable. Okay, perfect. So, I mean, what did we say here? We said 7.4% of second homes, 4.4% of like people booking hotel leisure trips. Uh,
And
okay,
I think
before we see what happens in
yeah,
reality, anything to add? Because I think,
yeah, I was just gonna say, like, sometimes these numbers, again, they're good for you got to understand, like, for both sides. So for a founder, if you're starting a business like this, and then as an investor to invest in
mm,
something like this, this is kind of the layer one of analysis. And it's really
mm,
it can feel quite intangible. I think just say 4% of hotel travelers, like,
mm.
but really, like, then what does that mean in reality? It
Yeah,
doesn't really give you a right to do it.
no,
It just shows you that it's maybe achievable.
yeah,
I would just want to say, from the founder perspective, then it's all around just like, Paul Graham said to the Airbnb guys, he was like, just find your first 100 users, find
yeah.
100 people that love this, and then go from
Yeah.
there. And so I think, yeah, because for an saying, oh, you need 16 million to make this work can feel quite daunting, but you've got to start
Yeah.
somewhere. And then this is just to tell you, you're not wasting your time. But
Yeah.
building the business,
That's a
you
really
got to
good point.
start from a small base,
You start with hundreds
obviously.
and thousands and 10,000, you go up like that, right?
Yeah.
That's a good point. But then from an investment point of view, because you mentioned to me something previously about surveys and things like that, because as you said, this 4.4% is fairly intangible even for an investor, right? And for a VC,
Hmm.
like how would you go about thinking, is this feasible?
Yeah, that's a fair point. I think on the survey side, you can. I know some of the bigger funds have this capability,
Mm.
or they either run the surveys themselves, or they pay someone like, like Ipsos Mori,
Yeah.
or any of these big companies that can do consumer surveying. And
Mm.
you could pay for a study to be done where you just, you know, you pick a type of person or holiday goer, and you just sample enough people
Mm-hmm.
just to get a read of like who would be willing to do this.
Who would convert maybe to Airbnb?
Yeah, because I guess I doubt that when this was being done, there was any data around
Yeah.
consumer preferences for this. So
Yeah.
maybe you would want to think about running some sort of study to get a bit more comfort.
Okay, perfect. Just to go back actually, for the supplies, how would you kind of validate that? Surveys? Like how many people would want to let out their homes to strangers? Like, I mean, for something like Airbnb, like it really is, like you said, like trusting the founders, no, and like kind of seeing initial progress because even like saying that sentence sounds crazy. Like how doing a survey of like, would you let your home out to strangers?
Yeah, I don't know. This is the whole thing. Like it's nuts. Like we were saying earlier, we estimated, this market size to be, big enough to build a 10 billion or a 50 billion dollar
Mm,
business in.
mm,
I think I mentioned at the very start when the founders did their first pitch deck,
mm.
their market size estimate was $20 million.
Yeah, 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 yeah.
They were building a product for a very, very different customer audience.
Yeah, yeah.
And so I think with game changing ideas like this, it's kind of
Mm.
you've really, it's a leap of faith
Yeah,
that
yeah. Which we'll come on to
something.
now actually, because we've kind of done our we've done
Yeah.
our like layer one, layer two kind of analysis. We'll go to reality, okay? Because
And
this
I
is
actually, sorry, just one quick point. That's what
yeah,
ventures for. Like if the numbers
yeah,
worked perfectly on a spreadsheet, a bank would finance this. So like
yeah. That's a very good
that's
point.
kind of why venture funds exist, because you've got to make a bet that this person is going to create something from nothing and completely change the way that consumers do things.
Yeah,
So there
yeah, yeah.
there there,
I
there
mean,
is an element of
that's what you're saying here,
um
right? That's why it's a 90% failure rate as well.
yeah,
Yeah.
yeah.
Okay. Um, you'll be pleased to know we were miles off. Okay, so what we modeled was 954 million is what the company will need to IPO, and we got there by saying, the company will have 4 average nights per trip. 24 million trips will get you to 95 million, around 95 million nights booked. If the average guest is charged $100 per night and Airbnb take 10%, that's how you get to this 954 million. What actually happened in reality was that when the company IPO'd in 2020, their 2019 numbers, were fairly close here. They averaged 4.1 nights per trip. There were 80 million trips that were booked in 2019, which meant a total nights booked of 327 million. The average nightly rate was $116, and Airbnb actually took 12.7% of the take rate, because a little bit like you were saying, initially they didn't charge hosts, but they now do charge hosts. And so the take rate has gone up. And so that meant Airbnb actually made a revenue of 4.8 billion revenues by 2019, which actually, even for the $500 million fund, would have been fine. And they could have funded it and made their return. Just for information, like 2022, how you see how this has grown with like scale, like this has stayed the same, average nights per trip. Number of trips booked has grown to 96 million. The average nightly rate has absolutely flown to $160. And this is kind of a point you made, as
Yeah.
initially Airbnb was pitched as this cheaper alternative to hotels, whereas it's not really the case anymore. And their take rate continues to grow because they've got a lot of control here. Like they can increase service fee for hosts and guests as they kind of like. But again, just quickly, what you were saying of even, I mean, we got it wrong, yeah. We downplayed the size of the market, but even Airbnb got it wrong, because this is, if anyone types in like Airbnb pitch deck into Google, they'll find this. But Airbnb, they thought, trips worldwide was about 1.9 billion. By the way, we had 2.7. So we were slightly higher, but not too ridiculous. 1.9 billion. They said they would only go for budget and online trips as their serviceable addressable market, which is 532 million. And they said they'll take a 2% share of that, which would be 11 million bookings. They then said 3 average nights per trip. The nightly rate would only be $70. And they said they'd only take like a 9.5% take rate. So Airbnb was saying over a 4-year period that they would make 220 million in revenues. So even if that was, let's say, by 2011, 80 million revenues or so a year, in 8 years' time, that 80 million would have had to grow into 4.8 billion. So I think even they were super, super underestimating, because I mean they were thinking 11 million trips. In reality, they got 327 million, like a few years down the line. So I mean, I think it kind of just shows what you're saying, though. Like, even if the founders can't really predict what's going on, how do investors have any idea? Which is where venture capital comes in, and it is a risk, right?
Yeah. And I think just to benchmark this, like they were planning to get to 220 million in revenue. I think most just another VC ism or like a benchmark is like, you use that 10 times revenue multiple. Most founders pitch to like an early stage fund, we will become a unicorn, $1 billion in value. So then the benchmark you use is $100 million in revenue. And so like every
Yeah.
pitch deck, you'll see path to 100 million ARR.
Yeah.
And so like that's kind of the North Star for founders. I think
Mm.
markets always change, technologies change, consumer preferences change.
Mm.
And so the best founders adapt with that. And like I think the Airbnb founders will have just been building their product, iterating
Mm.
it for their consumers.
Mm.
Suddenly, a new market appears or a change in the market appears, and they've just taken control of it and they were best positioned and they were
Mm.
lucky that the timing worked. And
Yeah.
that means they've managed to build like a 60, $80 billion business as opposed to a bit $1 billion business.
Yeah.
Or like most
Yeah.
founders, like not even $100 million business, right? They've it's kind of classic case of you know product perfect product at the perfect time.
Yeah.
um yeah, but
Perfect.
they were adaptable. And one point just on this take rate, like
Yeah.
you mentioned one point on once they had an established brand and established user base, they can increase the fees.
Mm.
But another thing you can do, and often is the case with marketplace businesses, is their core business is percent of the bookings.
Mm.
But once everyone uses your platform, you can layer on like insurance, cleaning fees, and
Yeah.
photography fees, and
Yeah.
all these other services. That basically means you have free customer acquisition, and you get all of that margin or a lot of that margin
Mm.
straight through. That's another reason why take rate will have increased, just because all
Yeah.
of these other financial services and whatnot.
Okay. Perfect. Mate, that's great. We'll end just quickly with Ashton Kutcher, but I guess the whole point of this was, um, okay, if you are looking at a new company, like what are the kind of things you'd first of all need to make your like investment work for your fund, and then working backwards for like an Airbnb, be like, okay, how do we hit those kind of revenues? What are the kind of drivers we need for demand, for supply? And one guy who did absolutely call this is Ashton Kutcher. So um he invested in Airbnb in Series A. I mean, we don't know his exact investment, but if we say he invested 10% of the round, 7 million, that's 700 grand he's invested in, which would have given him an ownership at investment of like 1%. We don't know when he exited, but if we, for hypothetical, as for this scenario, if we say he exited at IPO, he would have 10%, say, dilution per round. His ownership would have been 0.5%. Airbnb's valuation at IPO was actually 47 billion, which would have given him
Same.
a 250 million 250 million value from his like 700 grand investment, which is pretty tidy, right?
It's absolutely crazy. If this is true, it's one of the all-time great venture bets.
Yeah, because the thing is, I don't know when he exited, but this is the maths for his investment in Series A, which
Yeah,
is
and
absolutely
and sorry, just one quick point as well. It's like the power of picking. All venture funds want to invest as much as early as possible because you get the most
mm,
bang for your buck. The
mm,
reality is most companies like you want to drip feed your money in over time because there's
mm,
always
mm,
risk
mm,
there.
mm,
But
mm.
if you changed his initial investment to like what, even double it, so 1.4 million, it's an extra 700K, just got him 250 million more.
I
And
know.
I'm sure if you told him that at the time, he would have got 700K so quickly.
Yeah.
it's it just shows the kind of like insane returns when you get it right.
Yeah,
Quite
exactly.
scary.
And just final thing, by the way, when we talked about 10 times revenue valuation, I mean, AB's valuation was 47 billion IPO and their revenue was 4.8 billion. So it's about that 10 times that we talked about right at the beginning as well.
Yeah. Yeah.
So
Yeah.
mate, that is pretty much all I had to cover today. Anything else you wanted to say or caveat? I guess the only thing, like you said, is this is just like for for people at school, people at university, recent graduates to realize, okay, these are the kind of conversations, kind of thought processes you'd be having, but there's a heck of a lot of research and like kind of bottom up analysis that needs to be done.
Yeah. Yeah. I think hopefully this inspires some people to either be future investors or future founders.
Mm.
I think I would always guide people. It sounds a bit silly because I'm an investor, but I would always guide people to at least try founding something or dream to found something first.
Mm.
Clearly, the financial returns are incredible, but like this doesn't have. This is very much an outlier. I think it's a very good
Yeah.
example of like, if you could have found something, try and truly change the world with an idea, right? Like this was drastically different at the start.
mm.
Or if you're going to do the venture route, try and really change something, because that's what venture is for.
Yeah.
If you're going to build a business, you don't need to build Airbnb. You could build a hotel business and make good money. But if you want to do something big, venture is there for it. And yeah, if you want to excite venture capitalists, you got to come with a big dream and a industry changing idea. Not just, I get pictured with a lot of they call them incremental ideas, like just a new CRM or a new pricing tool or something. Like,
it's not world changing.
It's boring, and I think most investors now, the tide is turning a bit. There's a bit more appetite for things that are a bit more different.
Nice, man. Nice, mate. Stroud, really appreciate your time. Thanks for going through this. I hope this will help people who download this and give it a watch. And yeah, mate, appreciate it. And if we do this again, it'll be your fourth time on TVO. But thanks for your time, mate.
Yeah.